There is a strange paradox at the heart of the financial world. Wall Street, with its flashing screens, complex algorithms, and frantic trading floors, wants you to believe that investing is a game of constant motion. It wants you to feel that if you are not predicting the next macroeconomic shift or trading the latest hot stock, you are falling behind. But the most successful investor in modern history operates on a philosophy that is entirely the opposite. Warren Buffett's approach to building wealth is so straightforward, so stripped of unnecessary noise, that it is often overlooked by those searching for a secret formula. Yet, there is a blueprint. It is a specific, repeatable framework that Buffett has used for over 7 decades, and it is one he believes every investor, regardless of their starting capital or background, can and should follow. This blueprint does not require a genius-level IQ, an MBA from a prestigious university, or access to insider information. It simply requires a specific framework of thinking, a heavy dose of patience, and a temperament that refuses to be swayed by the madness of crowds. The foundation of this blueprint begins with what Buffett calls the circle of competence. Most investors fail because they feel compelled to have an opinion on everything. They read a headline about a breakthrough in biotechnology or a shift in semiconductor manufacturing, and they immediately feel the urge to risk their capital. Buffett's approach is entirely different. He views investing through the lens of a baseball player waiting for the perfect pitch. He famously draws upon the philosophy of baseball legend Ted Williams, who divided the strike zone into 77 cells. Williams knew that if he only swung at pitches in his sweet spot, his batting average would be exceptional. If he swung at pitches on the outer edges, his average would plummet. Investing is exactly the same, but with one massive advantage. There are no called strikes. The market can throw thousands of pitches at you every single day: a new tech IPO, a complex derivative, a struggling airline, and you do not have to swing at any of them. You can stand at the plate with the bat on your shoulder for years, waiting for a business you understand perfectly, priced at a level that makes sense. The size of your circle of competence does not matter. What matters is knowing exactly where the perimeter is and having the discipline to stay inside it. Once you have identified a business you understand, the next pillar of the blueprint is determining the difference between price and value. Price is simply what you pay. Value is what you get. This concept, inherited from Buffett's mentor Benjamin Graham, is the cornerstone of value investing. You are not buying a ticker symbol that bounces around on a screen. You are buying a fractional ownership stake in a real business with real employees, real products, and real cash flows. The goal is to calculate the intrinsic value of that business and then buy it with a margin of safety. This margin acts as a shock absorber for a bumpy road. It protects your capital if your calculations are slightly off, or if unexpected economic storms arrive. If you find value in stripping away the noise of Wall Street to focus on these timeless, enduring principles, consider leaving a like on this video. It helps us know that this is the kind of quiet, steady wisdom you want to see more of. The third layer of the blueprint involves evaluating the enduring nature of the business itself. Buffett looks for companies with an economic moat. Imagine a beautiful, highly profitable castle. Because it is profitable, enemies in the form of competitors will constantly try to storm the gates and take the wealth for themselves. To survive, the castle needs a deep, wide, and treacherous moat. In the business world, this moat can take many forms. It might be a brand so powerful that consumers will not accept substitutes like Coca-Cola. It might be a network effect where a service becomes more valuable as more people use it. Or it might be a structural cost advantage that no competitor can match. A wide moat protects the company's pricing power and ensures that it can continue to compound its earnings year after year, decade after decade. Without a moat, even the most brilliant business will eventually see its profits eroded by competition. But understanding moats, intrinsic value, and your circle of competence is still not enough. The true test of the blueprint lies in the mind. Temperament is the ultimate differentiator in the financial markets. Buffett often tells the allegory of Mr. Market, a manic depressive business partner who knocks on your door every single day, offering to either buy your share of the business or sell you his. On some days, Mr. Market is wildly euphoric, seeing nothing but sunny skies ahead. On these days, he demands a very high price for his shares. On other days, he is deeply depressed, convinced the world is ending. On these days, he is willing to sell his shares for a fraction of their true worth. The tragic mistake most investors make is letting Mr. Market dictate their emotions. When he is euphoric, they get greedy and buy at the top. When he is depressed, they get terrified and sell at the bottom. The blueprint requires you to use Mr. Market to your advantage, not to let him be your guide. You must learn to be fearful when others are greedy, and greedy only when others are fearful. This emotional discipline is remarkably rare. We all have moments where the market tests our nerves, where looking at a red portfolio makes us want to abandon our strategy. I would love to hear your thoughts in the comments below. What is the hardest emotional lesson you have had to learn on your own investing journey, and how did you overcome the urge to panic? For those who feel that analyzing moats and calculating intrinsic value requires too much time, Buffett has a final, incredibly powerful provision in his blueprint. In fact, he has stated that this is the most sensible path for 99% of people, the low-cost S&P 500 index fund. By consistently buying an index fund, you are essentially making a bet on the long-term success of American business. You are buying a slice of the 500 largest, most successful companies in the economy. You do not need to read balance sheets. You do not need to predict which industry will dominate the next decade. The index is self-cleansing. Dying companies naturally fall out, and rising innovators naturally take their place. If you commit to buying this index consistently through recessions, through boom times, through political crises and global pandemics, and if you keep your fees low, you will mathematically outperform the vast majority of highly paid professionals on Wall Street. It is a strategy of profound humility, yet it yields extraordinary results. Ultimately, Warren Buffett's wealth blueprint is an exercise in rationality and patience. It demands that you treat investing not as a casino, but as the serious allocation of capital into productive assets. It requires you to ignore the daily chatter, to turn off the financial news when it becomes hysterical, and to view market volatility as an opportunity rather than a threat. It is a philosophy that respects time as the heavy lifter in the creation of wealth, allowing the magic of compounding to do its work quietly in the background. Wealth is not built overnight, and it is rarely built by taking massive, speculative risks. It is built by making sound, rational decisions, and then having the immense psychological fortitude to simply do nothing, letting your capital grow over a lifetime. If you are committed to the long game, and if you want to continue building not just your wealth, but the temperament required to keep and grow it, consider subscribing to our channel. We will be here week after week exploring the profound and timeless blueprints of financial history, helping you build a future that lasts.